If you're a successful business owner with cash piling up inside your corporation, you might think you're doing the right thing. But without a proper plan, those retained earnings are shrinking. They're being eaten away by inflation and taxes. The good news, there's a smarter and more strategic way to use that money. My name's Laurent Munier, and I'm a partner and advisor here at Safe Pacific Financial, and we work with incorporated professionals and entrepreneurs all across Canada to protect capital, to reduce tax, and build long-term wealth using compliant, proven financial strategies. Let's get into it. Today's a big video, so grab a glass of wine or a cup of tea and get ready to take some notes. This is what they don't teach you in school, and not knowing these lessons and strategies could cost your business and your family hundreds of thousands or even millions of dollars. How you structure your business isn't just an administrative decision, it is the cornerstone of long-term tax efficiency, wealth accumulation, and intergenerational legacy planning. So whether you're launching a new business or you're already running a successful incorporated business, your structure directly impacts how much tax you pay, how you grow your wealth, and how smoothly you can transition assets later in life. So incorporation, when it's done properly, opens the door to powerful planning strategies that are not available as a sole proprietor or a partnership. So at Safe Pacific, we help business owners to understand and to leverage these benefits to their fullest. This includes things like maximizing your small business deduction. This is a federal and provincial tax break that allows incorporated Canadian businesses to pay a reduced corporate tax rate, usually like 12-13%, on the first $500,000 of active business income. So this is a major savings opportunity for business owners. Another one is income splitting with family members. When it's structured properly, your corporation can pay dividends to adult family members that are in lower tax brackets. So this reduces your overall family tax burden and keeps more money in your household. The rules around this have changed recently, so you need to make sure you're doing it compliantly. And that's where we come in, and that's where we can work with your accountant to make sure that if you are doing any sort of income splitting through the corporation, that you do it the right way. Because if you do it the wrong way, it could be very expensive penalties. Another one that doesn't get talked about enough, but is actually super important for business owners, is called the lifetime capital gains exemption. So here's the technical. If you own shares in a qualified small business corporation, a QSBC, you'll see it on the CRA website, you can get up to $1.25 million in lifetime capital gains exemption. So this means eventually when you sell your company, 1.2 million of that could be tax-free. Now, there's ways to do that, and there's things that you need to set up to have your corp in the right situation so that when you do sell, that you are able to take advantage of that. Another big one is that you can access advanced corporate planning tools. So once you're incorporated, you can implement wealth building and retirement tools like corporate-owned life insurance. So you can grow money inside there in a tax-sheltered cash value, and you can pass that on in a tax-free death benefit. Another one you can talk about is called an individual pension plan, or an IPP. This is ideal for higher income earners that are looking to create a guaranteed retirement income. IPPs fell out of favor basically forever, but over the last couple of years, there's been some tax changes from the Ministry of Finance and from the CRA, and IPPs have come back into favor. There's some pros and there's some cons, and you really got to know what you're doing if you're setting these things up, but they are sort of back on the table now because the government changed the rules and made these things attractive again. And then the last one that you want to know about is called a retirement compensation arrangement, or can be seen as an RCA. This is for owners who want to have flexible corporate-funded retirement strategies. So we work with business owners and incorporated professionals of all types, whether that's lawyers, dentists, doctors, engineers, software developers, all types of high-income professionals, to ensure that their corporate structure is fully optimized. And not just for the business operations, but for advanced portfolio growth, for tax reduction, and really for estate planning. So if you're holding significant retained earnings inside the corporation, or if you're just starting out and you don't have retained earnings yet, it is really important to lay down the foundation and to do it right. Because when it's done right, the business structure becomes a tool to build and protect your personal wealth for generations. Now, you probably want to keep more of your money and have smarter tax planning. Tax planning is one of the most overlooked areas where Canadian business owners can lose thousands of dollars or hundreds of thousands or millions of dollars over their lifetime. Many incorporated business owners and professionals and entrepreneurs, or even family business owners, they really focus on their annual tax filing, but they miss out on the long-term strategic optimization opportunities. So again, you want to go beyond basic compliance. This is what we do. Actually, this is what we do. We work with literally hundreds of business owners all across the country. So we have a lot of live experience seeing what works and doesn't. And we know what very many successful business owners are doing and can bring that knowledge to you, which is, why we make these videos. And also we work with your financial team. So this isn't just us doing this by ourselves. We work with your lawyer, your accountant, your banker, your other investment professionals to help to design compliant tax strategies to keep more of your hard-earned money working for you, both inside your corporation and also in your personal financial plan. And now here's a few of these smart tax strategies that we implement for clients, but you should also look these things up and see if they're maybe relevant for you. And you can work with your own people on this, or, you can reach out to us through our website or through the link that's in this video below. One that comes up, and it's actually pretty basic. Do you pay yourself a salary or do you pay yourself a dividend? So this is a big distinction that many business owners wonder about. And it's usually one of the first things that's come up is do I pay myself a salary or dividend? So there's pros and cons to each. And the basic default advice of the past doesn't really work anymore. So in the past, you used to generally be able to say that paying yourself a dividend would cost less in tax, both personally and through the corporation. And so most business owners would pay themselves a dividend. And that was just, you were saving some money. There were some disadvantages to that because when you're paying yourself a dividend, that doesn't count as income. So if you're looking to get a mortgage or something from a bank, dividend don't show up as income. So it's actually better to pay yourself a salary if you're going to be looking for big loans from a bank. Dividends don't also contribute to your RRSP room. So if you're going to be using an RRSP for retirement income, then you want to have some salary years so that you can build up your RRSP rule. But really, depending on your situation and on your goals, we can help you figure out what's the best way to pay yourself, because there isn't now just that default pay yourself a dividend. There's a thing called tax integration in Canada, which means that there's super complex ways to explain this, but the really easy basic way is there shouldn't be an advantage for you to pay yourself this way or this way from a tax perspective in Canada. So whether the corporation pays this much tax and you pay this much tax, it should add up to around the same. And now with integration, and these rules have been changed over the last couple of years, as from a tax perspective, there's not really a huge advantage to go dividend versus salary or salary versus dividend. So you got to look at the other stuff. And again, this is something that you're going to do with your accountant, because your accountant is the one that's going to, or whoever does your payroll, these are the people that are going to adjust how you get paid. But there's no blanket answer for this one. And again, and actually, what comes up a lot is people's personal opinions and people's personal feelings of how they want to do this. For many business owners, dividends that are paid to their spouse or to adult children can reduce the overall household tax bill, but you also have to make sure that you stay compliant within the CRA rules, and you work with your advisors, you work with either whoever does your payroll, or it might be your accountant, and make sure that you're doing it the right way. And that if you are paying dividends to yourself, or if you're paying yourself a salary, or if you're paying dividends to people in your family, that is properly documented and that you're doing it in the right way, because the penalties can be big. This is another thing that we help people with. So now we don't set this up ourselves, but we will tell people to talk to their lawyer and see if you can go get this done. And it's called an estate freeze. And it's usually you're doing this at the same time as you're setting up some sort of family trust, or maybe if you're selling assets, like you're selling buildings, or maybe you're selling a corporation, and you could do an estate freeze. So if you're planning on passing the business or your investments to your next generation, the estate freeze combined with a family trust can be really an extremely effective way to lock in your tax liability today and allow the future growth of the company to be for your children or your grandchildren. And then this structure also lets you multiply what's called your lifetime capital gains exemption, which we talked about, across multiple family members. So this could save you hundreds of thousands or millions of dollars in capital gains when you essentially or eventually will sell or transfer the business to the next generation. Again, that's more the complex by the book way of explaining how it works. What does it mean in real English? An estate freeze basically means you took your company from $0 to $1 million, and now you're going to sell it to whoever. So you can say, okay, I'm going to freeze the value of this company today at $1 million. And the taxes from 0 to $1 million, those are my problem. And I'm going to pay those out, however I pay those out over time. So now my kids are now taking up the company. They're starting it at $1 million. Anything above $1 million is going to be their tax problem. That's not going to be my problem. And the 0 to $1 million is not their problem. So that's essentially what an estate freeze does in a very basic way that's easy to understand, because when you actually just read the, definitions of it, they're kind of complex and it's made more complicated. Now, here's another one that's really important. It's called corporate owned life insurance, and you put it inside your holding company. So you have to have a holding company for this to work. So we often do this. We often structure these participating whole life policies that are inside the holding company that'll help the clients to grow their wealth in a tax sheltered way. These policies accumulate a compounding cash value over time that grows through a dividend that you can access tax efficiently through policy loans or through collateral loans from a bank. Plus, when you eventually pass away, the majority of the death benefit from this insurance can flow tax-free to your beneficiaries through what's called a capital dividend account, or a CDA. So this creates like a really efficient way to pass on business wealth to the next generation. Now, nothing that I've talked about here, these are not aggressive tax strategies. Generally here with what we do, we're pretty boring, we're pretty vanilla. These are smart strategic moves that are fully compliant with Canadian tax laws that are really designed to build and to preserve your wealth over the long term. So, most of the clients that we talk to, they're really frustrated by the amount of tax that they're paying now. And they're also really worried about the amount of tax that they're going to have to pay in retirement. And they're also really worried about the amount of tax that they're going to have to pay when they want to pass this on to their next generation or their kids, right? So if you're thinking about the future of your business, of your family, talk to somebody, right? It doesn't need to be us. It could be your own advisors. It could be us if you want. The link is down below if you want to get in touch with us. We really specialize in this, in working with incorporated business owners and with professionals who want this strategic, tax-efficient wealth planning. Not just the tax filing. That's your accountant. Your accountant will do that. But we want to make sure that your money is working harder, growing smarter, and it's protected for the next generation, right? Because why are you working so hard? Most people are usually working so hard so that they can give something to their kids. That's the majority of our clients. So those are a lot of problems. What's the solution? How do you put your surplus corporate cash to work? If you're a Canadian business owner or you're a professional that's incorporated and you've got these retained earnings that are building up inside your company, it might be your operating company or it might be your holding company, letting the cash sit idle might feel safe to you, but really it's costing you money. Your surplus corporate cash that isn't actively invested properly. So for example, your money's sitting in a checking account or it's in a GIC. It's probably losing value to inflation, and it is subject to high passive investment tax rates. So up to 50% taxable, depending on whatever province you live in. So this can significantly reduce your corporation's long-term earning potential and jeopardize your access to what's called the Small Business Deduction. So if your passive income exceeds $50,000 annually, it starts to take away your small business deduction if you have one. So after working with hundreds of Canadian business owners over the last 14 years, I've seen what works and I've seen what doesn't work. So here's some things that we do to make sure that you don't lose money to inflation and taxes every year. And again, this is what we do. Other people might do other things, but this has worked for our clients. Number one, this is a big one. Corporate participating whole life insurance inside the holding company. Now, I just talked about this, but really it's one of the smartest places to store your corporate surplus funds, right? It's inside one of these participating whole life insurance policies that's owned by the holding company. We have tons of videos on this topic that are on our YouTube channel and on our website. So click somewhere on this video and there'll be a playlist of our life insurance videos. These corporate owned policies offer safe, stable, tax-deferred growth on your cash, and they generate annual dividends, they can be structured to provide liquidity. So as you build up this cash inside the policy, you can get collateral lending from banks. These policies also deliver a tax-free death benefit to the corporation, which can be paid out through a capital dividend account to your beneficiaries. And this can generate a really powerful tax-efficient wealth transfer to your family and to your kids. And best of all, the growth inside these policies doesn't count towards the passive income rules, which was a tax grab that our genius government put into effect a couple of years ago. So the growth inside your life insurance policy doesn't negatively affect your small business tax rate. It also helps to create tax-efficient access to funds. So instead of triggering tax by paying yourself a dividend or selling investments, you could access the cash value inside your life insurance policy through collateral loans from banks or through policy loans from the insurance company. And usually you can do this tax-free. There's ways that you can make it not tax-free, but again, work with somebody who knows what they're doing, and we can make it tax-free. I just need to say it's usually tax-free because it's not guaranteed that it's always going to be. But this strategy really allows you to tap into your corporate capital without having to sell assets or without triggering capital gains. So you can get the liquidity that you need when you need it while your policy continues to grow in the background. And then what do you do with it, right? So you could finance future business opportunities, or you could finance retirement, or you could finance investments. You do whatever you want. So whether you're looking to reinvest in the company, whether you're buying properties, whether you're funding retirement, using the surplus cash strategically can unlock those goals faster. Again, without losing half of your money to the CRA. The right structure allows you to maintain control of your capital. It allows you to build wealth inside the corporation, and it allows you to fund major life goals while minimizing the tax exposure. Now, here's another benefit actually that doesn't get talked about a lot here on YouTube or just generally, but how do you retain top talent with enhanced employee benefit plans? So if you're a Canadian business owner or you're an incorporated professional, attracting and retaining top performing employees is really important. And not just for your day-to-day obligations and your operations, but for the long-term stability and the scalability of your company. So today, top talent isn't just looking for the paycheck, they're evaluating the total compensation package. So this includes retirement benefits, savings plans, long-term security. And here's a couple of tools that make a strong employee benefits plan. Now, you can do group RRSPs. So this is something that we've set up for a bunch of companies. I don't really talk about it a lot on this channel because we're not out looking for this type of business, but we're usually doing it for our business owner clients that are, hey, you're doing all this stuff. Can you also just do this for me? Yes, we can. But group RRSPs are awesome. Employees love it. And it's super easy for you as the employer to set these things up and to automate the contributions that are in line with your existing payroll dates. The process to set these things up is super simple and it's seamless. And the RRSP matching is worth so much for employees. The benefit to the employees is that any of their contributions can reduce their current taxable income, right? Because it's an RRSP. So the contributions are tax deductible, and then the growth inside is tax deferred. So it's a win-win for you and it's a win-win for the employees. If you're a high earning person, if you own the company, or if you're a high earning executive, or you're an incorporated professional and you're earning more where your RRSP contribution limit is just not that big, or it doesn't make a dent in your financial plan, you could look at what's called an individual pension plan or an IPP. So these offer significantly higher contribution limits than an RRSP, especially if you're over 40 years old. IPPs have been around for a long time, but nobody really used them before because they were onerous to set up, they're onerous to maintain. That's why you didn't hear a lot about IPPs back in the day. But since the government changed the passive income rules a few years ago, IPPs have come back in favor because they allow larger contributions into a tax-deferred account. So it's a powerful retirement planning tool that allows incorporated business owners to shelter more income, to lower their tax exposure, and to provide stable retirement income that's backed by an actuarial support. You're actually setting up an actual pension for yourself. So the way it would pay out is like a pension, right? You've got like a really solid, stable retirement income. I don't talk a lot about it on this channel, but it is something that we set up for business owners and for their employees. There's some complexities to it. So definitely you want to work with somebody who knows what they're doing. You don't want to be somebody's first IPP that they've ever done. But reach out to us via the link that's below if you want to know more about setting up an IPP for yourself or setting up a group RRSP for your employees. You can book a meeting in our calendar, or you can send us a message. You can also use the corporate-owned life insurance that we talked about as an executive benefit. So life insurance-based strategies can also play a role in compensation, and a corporate-owned participating whole life insurance policy can be used to fund executive bonuses. It can be used for succession planning, or it could even be a form of deferred compensation. When you structure it properly, these policies can grow tax-sheltered, and they can provide access to a cash value that can be used for strategic business reasons, right? Like whatever you want to do. Or it could be a retirement bonus for key personnel. We do this a lot for the owners that still work in their companies, but are also employees. So you own the company, but you also work there. And by integrating enhanced benefit plans into your compensation strategy, you're not just offering the perks for your employees or for yourself, you're creating real long-term value for your team and for your business. So these plans that I've talked about, they help to reduce turnover and hiring costs because it is expensive and it's a huge pain to hire new people after you lose people. So better not to lose them in the first place. It really improves team loyalty because they're now tied to you for more reasons, right? Their retirement plan is dependent on you. It can create tax savings if you're using deferred compensation options, and it can build a stronger and more attractive corporate culture. And then you as an owner as well, if you're contributing to people's RRSPs, you know that your employees are more stable because you're contributing to their savings, and having more savings and having more financial freedom and stability is good for people. Another thing we want to talk about right now is to prepare for the unexpected and build a tax-efficient exit strategy for your business. If you're a successful Canadian business owner, you've spent years, maybe decades building the company. But have you planned for what happens if life throws you a curveball? This could be an unexpected illness. It could be an accident. It could be simply preparing to retire or having a solid business succession and contingency plan. This is one of the smartest wealth management moves that you can make. This is what we do. We help incorporated professionals and entrepreneurs across Canada to plan for the unexpected and to build structured exit strategies that align with their personal and corporate and family goals. That's a lot. That's a mouthful. Here's what it actually looks like. So you want to have contingency plan for illness, disability, or death. These are the physical things that could happen to you. And if any one of these things happens to you, it's probably going to hurt your business. So the harsh truth is life doesn't always go as planned. So that's why having a continuity plan is essential. We help clients to prepare for this, the financial impact of, say, a critical illness or a disability, by integrating tools like disability insurance to replace your income if you can't work. Definitely, you should have disability insurance, and most people don't, but it's super important, and it is actually the most claimed type of insurance. So if you're betting on whether I'm going to collect on this insurance, your odds are higher that you're going to collect a disability policy than you are going to collect on a life insurance policy. There's also critical illness insurance. This pays you a lump sum tax-free if you're diagnosed with one of the major conditions that's offered by that insurance company. Usually there's like a list of 25 different things like cancer, stroke, heart attack, Parkinson's, multiple sclerosis, Alzheimer's. There's all sorts of basically 25 things that you don't want. But if you do get one of these, a lump sum pays out so that you can take the time to get better and so that you can still pay your mortgage and keep the lights on and, send little Johnny to soccer practice. Another thing that you want to do is have a buy and sell agreement that is funded by life insurance so that partners can buy out your shares or that you can buy out your partner's shares without jeopardizing the business. So most buy-sell agreements get written up by the lawyer. They're pretty boilerplate. And in the buy-sell agreement, it'll usually say this should be funded by insurance. But many buy-sell agreements are not funded by insurance because once you sign it, you take it and you put it in a drawer and you don't look at it, and then you never actually go get the insurance that it says you're supposed to have. So if you want us to look at your buy-sell agreement and make sure that you're compliant with the terms that are inside there and that you have the insurance that you're supposed to have, that you signed, that you wanted to get, we can do that for you. But with the right protection in place, the company can keep operating smoothly even if you're not there anymore, right? And then this last bit is about succession planning and your actual exit strategy. So whether you're planning to sell the business, whether you're retiring or you're passing it on to the next generation, the earlier you can make this plan for exit, the better. We help business owners to identify their succession goals, right? Is the family going to take this over? Are you going to sell it? Are employees going to take this over? Or you've got like a manager that's gung-ho that wants to take it over? So you want to figure this out as soon as possible and as far in advance as possible. You can also minimize your tax through the lifetime capital gains exemption. And again, here, this is something that you want to do in advance. You don't want to show up today, sell your business tomorrow, and then say, okay, now I need to do all this tax planning, because you can't. You need to do the tax planning years in advance so that when the situation does happen, now you can do it. You also want to ensure that your company shares are structured to qualify as a qualified small business corporation if you're at that size, right? So you want your shares to be set up in the right way. And again, this is where you want to work with, you want somebody to tell you what to do, but then you also work with your accountant and your lawyer to make sure that they actually write the paperwork to make it so that these shares are set up in the right way. You can also look at using an estate freeze and look at using a family trust to pass this wealth efficiently to the next generation. So having a clear roadmap means that you can step back from the business with confidence. So you're not leaving your wealth, your employees, your family in chaos. And then this is where we help. We work with your different financial advisors, with your lawyer, with your accountant. There's even succession planning consultants on getting your plan built and funded and really like designing like, what do you want to do, right? It's actually kind of crazy how many business owners don't have a written succession plan. I actually host Western Canada's largest estate planning summit. And one of the most impactful things that one of the speakers said from the stage, it still actually resonates, and I quote this to people all the time, is you will have a succession. It's either going to happen the way you planned, or it's probably going to be a heart attack or stroke or cancer or something unplanned that does your succession for you. For the amount of time that it takes to write out the plan, I would 100% recommend that you write a succession plan, and that when it's time to do the succession, that you try to do it on the way that you want versus, the stroke tells you that now you're no longer working in your business and whatever you didn't do now is a giant mess, and hopefully somebody's able to figure this out. From a personal story, actually, in the last 3 years, this is wild, but in the last 3 years, this story has come up 3 different times on 3 different people. And what's kind of even worse about it is people in our industry that should know better, where they've just died. 3 different people have died in the last 3 years without a will, without a succession plan for the company. And then now their business is in chaos. And then their family has to step in and try to figure out what's going on. Do they sell it? Do they try to take it over? Do they try to run it? And none of this has been planned in advance. And these financial advisors that this is their job and probably have coached other people how to do this, they didn't do it for themselves. So you're getting into the situation of, right, the cobbler's kids have dirty shoes. The succession plan is going to happen. It's either going to happen the way you want it to happen, or it's going to happen, the world is going to happen it to you. So some things that you can do. One thing that you definitely want to do is to get a professional valuation. This is actually really important. So again, big mistake that we see is business owners waiting to the last minute to think about a valuation. So if you want to maximize the value of your company before you exit, you need to start prepping this years in advance. I would say like at least 2 years in advance, but better if it's somewhere like 5, 4, 3, 2 years in advance. So this includes a few things. Number 1 is actually getting a professional valuation before your exit window. Another thing you want to do is clean up your financials and your shareholder structure. So if you haven't looked at your shareholders agreement and you haven't looked at your incorporation documents and you don't actually know how your shares are set up, and you haven't looked at this since the beginning when you set up your company 10 years ago, you might want to talk to your lawyer who did this and say, does this still make sense to be set up in this way? You also want to identify risk areas that could reduce your valuation. So when you talk to your professional evaluator, they're going to tell you these things could mess up how much you think you're going to get for your company. You also want to try to enhance your EBITDA. So when you're buying and selling companies, EBITDA is the number that they usually use to make your valuation of how much I'm going to pay you to buy this company. So you want to do this through strategic planning and through optimization. You want to make sure that your business is running smoothly and that it's making as much as possible so that when you sell it for as much as possible. So now if you're a Canadian business owner who wants to save tax, who wants to grow your wealth, protect your legacy, let's talk. This is what we do. Visit safepacific.com and you can book a complimentary strategy session with one of our advisors. You can click on the buttons that are on our site. They'll all take you either to schedule a time straight in our calendar, or you can send us an email. There's also links below this video if you're watching on YouTube or on LinkedIn or on Facebook, and those links will take you to the right page where you can set up a time. Now, I hope today's video was helpful for you, and if you did find it helpful, could I ask you for help? I'm trying to get these videos out to more successful business owners that are like you. So please do all those things that the algorithm loves. That means click on the like button, click on subscribe if you're not already. There's a notification bell so you don't miss next week's video. And if you have any questions, leave them in the comments below. Somebody checks those all the time and we do reply. So thanks for watching. I will see you next time.